Hi, Greg Lewis, MetaStock Software. Your presentation will start in about 30 seconds. I just want to take a moment to tell you about our upcoming 10th annual MetaStock Traders Conference in Southern California and how you can save $200 when you attend. You're invited to join us on October 8th and 9th, 2016 for our largest annual event packed with valuable trading information you can use to improve your portfolio. You won't want to miss this opportunity to learn from industry experts like Rob Hoffman, Greg Morris, Oscar Carboni, Vince Vora, Price Headley, and more. If you'd like to register for this event or just want to find out more, visit metastock.com/conference. The first 20 registrants save $200. If you're seeing this after October 8th, 2016, visit metastock.com/conference anyway to see about upcoming events. Thank you, and we hope you enjoy this presentation.
Let's go ahead and get started. Hope everyone can still hear me okay. My name is Hunter Smith with MetaStock, and I'd like to welcome you to our webinar in conjunction with TA Academy and a gentleman, Jose CID, from TA Academy. We've actually been working with Jose for quite a while. Very excited to have him speak here today. First off, if you've seen one of our webinars before, you know that we have to do the disclaimer, so I'll go through that real quick. This demonstration is designed to instruct you on using MetaStock and accompanying software plugins, and it's not a recommendation to buy or sell, but rather guidelines to interpreting and using the specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock shall have no liability for any investment decisions based on the use of their software, any trading strategies or information provided in connection with the company. Now that we have the legal stuff out of the way, Mr. Jose CID, he's actually been trading for a very long time. He lives in Canada and he trades stocks and ETFs in the US as well as Canada, and also things on the Brazilian market. He has many courses available actually at the TA Academy, just taacademy.com. And like I said, I've been working with Jose for quite a while now. He has some very good insights and processes that work very well, and he is going to share those with us today. If you have questions throughout the presentation, you may type them into the chat box, and we'll definitely get around to answering those questions. Jose, can you hear me okay?
Let me turn on my phone, my microphone. Hi, Hunter. Thank you very much for the introduction. In fact, I was going through my archives here, and I've been using MetaStock for almost 20 years. It's interesting. And I saw the evolution throughout the years and the many versions. It's an awesome software. It's really my main tool nowadays. Let me see. How can I share the screen? This one. Can everybody see my screen?
Perfect. Looks good.
Okay. So it should be a PowerPoint presentation. I have multiple screens. I hope I shared the right one. So as Hunter was explaining, I have a online course website where people can register and watch the videos and send me questions. However, the website is going through renovation now, and it should be up and running by the end of next month. And it will be a whole new set of courses that will be available. And the first one will be part of a special promotion today with MetaStock. I also have a website, the Trendlines, thetrendlines.com, where I post analysis of the market. It's exclusively analysis. It's not a trading tips website. It's technically analyzing the market, and also using other tools like geopolitical tools and fundamental tools to get an understanding of what's going on in the market. So what I have today to present, it's an overview of the, let's say, the requirements that a trader has from their systems. So as traders or investors, we need to have systems and procedures. Pardon me if I'm being so emphatic on that, as Hunter said, but I'm an engineer by training, and I've been working with research and development since I started my career back in the 80s. So I'm used to have systems and procedures to follow. And because that's only with systems and procedures that you can repeat your success. So MetaStock, as I said, has been a very important tool for me to find high probability trades and to create those systems. I do all my research, my technical analysis research, using MetaStock. And as Hunter, I'll start with a disclaimer that has the function of reminding you that everything that I say, it's not a recommendation to buy or sell, but guidelines on how to interpret price charts. And that interpretation needs to be really in line with your goals, with what you plan to obtain from the market. And I discussed this in very much detail on the business of trading course that I have. Another thing that you need to keep in mind is that there is always a risk associated with the markets. Because even though we study the past to try to understand what can happen in the future, we are never sure of the outcome. So we need to have a plan B, and we need to know how much money we are risking. And the things that I'm going to show here are happened in the past. So in hindsight, it's easy to see what happened on the charts. But I want you to keep in mind that we need to understand what happened in the past to be able to understand what might come up in the future. And throughout the presentation, if you have any question, you can write on the chat window, and I will answer the question as we go along in the presentation. So first thing that we need to cover is the distinction between being a technical analyst and being a trader. The analyst and the trader have very different objectives. The analyst wants to find out where the market or where a certain stock or ETF is going. The trader wants to make money. It doesn't matter where the market is going. So this is very important because sometimes I see people with a very good understanding on where the market is headed to, but they can't make money in the market because they don't understand the subtleties of doing entry at the right time, and most importantly, doing an exit at the right time. The analyst wants to find if the trend is up or down, and the trader wants to make money no matter what type of trend we have. The analyst wants to find locations for potential bottom or top, and that's true. There are always some location on the right side of the chart that has a very good chance of having a potential bottom or potential top. but that doesn't mean we can trade that information. The trader needs to find ways of making money. And sometimes we can make money with very silly systems. The type of tools an analyst use are very different than what a trader uses. An analyst will try to use all the oscillators, try to analyze volatility, and try to identify trends using different indicators. They will try to understand the sentiment behind the moves, and they will look at chart features or figures like head and shoulders, triangle, trend lines, Fibonacci waves, Elliott waves, whatever you want to use. There are many tools that one analyst can use, and that can become overwhelming with time. A trader wants to use whatever makes money. So I know people that makes money trading only with moving averages, or people that makes money trading only with RSI, or trading only with candles, or trading only with Elliott waves. It doesn't matter. It's the tool that helps that person makes money. A trader also understand that the price action is the most important information, because if the price is not moving in the right direction for the trader, there's no way of making money. If it goes in the direction of the trade, wonderful. If it doesn't go, we need to get out quickly. Support and resistance, it's very important for a trader as some type of trend definition. It's important, but not as important as the support and resistance. A trader always keeps a book with all the trades and strategies that he or she used. And that's where you will find the most likely strategies that work with his or her beliefs. Because we trade in the market, what we do with our money, it's much more connected to our beliefs than with real things that cannot, that are like physics, for example. We do not discuss physics because it's the law of nature. In the market, we act on beliefs. That's why for the market, for the trader to make money, mindset is everything. For example, here I have a chart that's the Dow Jones within several months, and I have 3 different indicators in the bottom. For me, those 3 indicators give the same information. But for many analysts, they will see different things. In the first one, we have the tricks, then we have the MACD, and then we have RSI. All of them, for me, gives the same information. The same things that I can find on MACD, on MACD, I can find on RSI or the tricks. It doesn't matter. And the only one that would give it somewhat different information is the stochastic. So if I see someone combining the information from MACD with information from RSI, I know that person doesn't know very well what he or she is doing. So mindset, it's very important. As I said, and analysts have a different mindset than a trader. The analyst has a lot of ego. It's my analysis. I want to be right. So most of the times there's a lot of doubt. And did I use all the tools that I should use? Do I miss something? And the analyst will get excited when right. Oh, my analysis was great. I'm a wonderful analyst. And will feel down if he or she makes a mistake. And that can hurt even the way that person behaves outside the markets. So if analysis is wrong, he or she will go back to the drawing table to figure out what he or she forgot to analyze. And it's not a matter of forgetting to analyze. It's because the market has its own behavior, and the indicators only highlight a little part of that multitude of behaviors that the market exhibits at any time. One thing that people always forget about indicators is that they were created with something in mind. For example, Welles Wilder, when he created RSI, he had something in mind. If you don't understand this, you cannot use it properly. And so as analysis, you need to understand how and why that indicator was created. So an analyst will improve by learning new tools, new indicators, or how the indicator works and how that indicator will translate the market behavior into a number. A trader has a very different mindset. A trader has no ego. Whatever happens, it is in the strategy. The strategy has been honed through many trades, and many times he made a mistake and tweaked the strategy to make it better and better. It's something that has been adjusted throughout sometimes years that it takes to develop a strategy. And the trader has no doubt when there is one entry, the trader enters and they exit when the exit signal comes. There are no strong emotions. It's basically it's just money. You want to execute your strategy because you know that statistically your strategy is a winning strategy. A trader quickly recovers from a loss, and it's always looking for opportunities to make money. A trader has a very special attention to risk management because that's where money is made. It's more important to not lose big chunks of money than to make money every day or to make big chunks of money at one time. And a trader has no desire to learn a new indicator or tool. After he or she develops their systems, their process, there's no need to learn something new. It's just execution. And a trader focuses on improvements by gaining more practice and testing that strategy, developing that strategy into new markets. So let's see what's the concept behind trading, using technical analysis for trading. First of all, we need trends. We need to know the trend is going up, or it's going down, or it's going sideways. There are three trends in the market: up, down, and sideways. So we can make money in all three, but there is no strategy that will work for all three trends. A strategy is usually good for a certain type of trend, and that's we need first to identify the trend to choose the right strategy. And the desire we have is always to have a better risk control, to have simple strategies, because if it's too complex, too many things that needs to be analyzed or thought about, we have a higher chance of making a mistake. And we want to capture a large portion of the uptrend or downtrend. And by large, I mean safe. What's the biggest move that I can capture that is safe and does not jeopardize my risk control? And also, a very important desire for normal people like us is to have strategies that comply with long-only trades, because that's the type of trade we have to make on our retirement savings accounts, or if you are in Canada, the tax-free savings account. We need to have long-only strategies, because those type of accounts require or do not allow short selling. And it's very important to develop a process and explore the trend definitions, because there are many, hundreds of trend definitions. But we need to explore which one have it's more in line with the way we believe the market behaves. There are many definitions, but some do not appeal to our beliefs. All of them have strengths and weaknesses. They work in certain conditions. In different situations, they are not usable. We need to use something else. And to help me, and then MetaStock is very good for this, I use automated explorations. It's part of my process to use the Explorer on MetaStock to find potential good trades. So here I have a generic chart. It's a monthly chart of the TSX, and here we can see strong uptrends that lasted for a long time, and strong downtrends that lasted for some time. We can notice here several things in that chart in respect with those trends. So the uptrends, most of the candles are green, so the close is above the opening. It sounds silly to be talking about this, but it's not perfectly obvious for most of the people. And one important characteristic of the uptrend is that the moves last longer, or it takes longer to move up. And in general, the market has an uptrend bias. We can see here in the chart that even though we had strong downtrends that lasted sometimes even over 2 years, more than 2 years, overall the market is going up. So this is what I mean by an uptrend bias. And there are always small down moves within an uptrend. That's the so-called correction within an uptrend. On a downtrend, there are very important differences. So most of the candles are red, but the moves are faster. This is very important, and that it's one of the main reasons strategies that work well on an uptrend do not work well on a downtrend. And a downtrend will correct most of the previous uptrend, but not all. And there are always small up moves within a downtrend. So for a trend lines to be useful to make money, we need to be able to identify some things. First of all, we need to know the current trends, if it's going up or down or sideways. We need to know the health of the current trends, if the trend is strong, or if it's weakening, or if it's going through a correction. We need to understand the changes in the current trends. And that might be corrections that can go sideways or down, and that will sometimes exhibit weakness or sometimes exhibit strength. Short-term counter trends are just corrections within a trend, or when we have a definite change, the characteristic of a definite change from up to down, long-term up to long-term down, are very different from short-term trend change. And we need to identify those early enough to be tradable. If we don't get on the trade early enough, it doesn't need to be right at the beginning, but it needs to be early enough to be tradable. And we need to understand that the most important thing is when the analysis is wrong, we need to manage the drawdown. For me, the only risk is drawdown. It's to lose money. I don't see a risk in high volatility. I don't see risk when the market it has been up for X number of days, 5, 8, 10 days. I don't see risk on that. The risk I see it's on the drawdown. That's how I manage risk for myself. And I need to change my position quickly when my analysis is wrong. So before we move, before we proceed, let's take a look quickly on the history to give you a feel that technical analysis is not something that appeared out of the blue in the last few years. It has been around for a long, long time, and in Japan, there was a very strong rice trading market, and there is that Sakata's constitution that was created by a very famous trader, Hama, his name, that lines some important things that any trader or any speculator needs to have in mind to be successful. And notice that he starts by saying, without being greedy, being greedy, it's a mindset. A trader is not greedy. A trader executes a process. A trader buys and sells when they have a buy or sell signal. It's not because they saw something on the news or analyst X or Y said something about that company, or Apple, it's releasing a new device I need to buy. That's not how it works for a trader or a speculator. And as without being greedy, we need to think about time and price ratio. So in the 18th century, he already had understanding that price is the most important indicator. And he said attempt to sell at the top and buy at the bottom. It's an attempt. He doesn't say that you have to. You try to, but at first you need to be sure it is a top or there is a bottom. And one should increase one position after a rise of 100 bags from the bottom or a fall of 100 bags from the top. And that's a important statement also, because he's talking about adding to a successful position. We do not add to losing position. And he talks here about bags because at that time price for rice was fixed and the number of bags traded changed. So he wants to build up on successful positions. If the price went up 100 bags, I buy more bags of rice, and so on. So I'm successful, I can buy more. If one forecasts the market incorrectly, one should attempt to identify the error as soon as possible. and liquidate the position and rest on the side for 40 to 50 days. Why that recommendation? First of all, quickly identify errors and get out, because they will happen. The quicker you identify them and get out, the better for you. And then you rest on the side. You don't need to trade again right away. You need to clear your mind, because the mindset is the most important thing that a trader has to work on the markets. And one should liquidate 70 to 80% of one's profitable positions and liquidate the remainder after the trend changes. So when we get closer to the top, we eliminate positions. And it's very interesting, this statement here, because my research shows me, and that's the way I deal with my own strategies, is if I have a target to exit, it's more profitable than if I exit after the trend changes. And we are going to talk more about that down in the presentation. In the 19th century, price charts were most likely introduced in Japan for the silver market around 1870. And in North America, Charles Dow is considered the father of modern technical analysis. The Dow Jones Company was founded in 1882, and in 1884, they came with the first version of the Dow Jones Index. In 1886 was the first version of the Dow Jones Industrial Average. And Charles Dow used to write about price patterns such as lines and double tops and bottoms. And lines here, it's the sideways move, when the price moves sideways in a very narrow range. That's what Dow used to call a line. In the 20th century, so last century, Nelson publishes the ABC of Stock Speculation, which is a compilation of Dow's essays in the, he coins the term Dow theory. It was not coined by Dow. He had already passed away when Nelson published that book. Hampton and Lear and Nelson continued the work of Dow. And in the 20s, Richard Wyckoff started publishing a technical analysis newsletter that reached 200,000 subscribers. Try to think this, in 1920s, 200,000 subscribers. A lot of people interested in technical analysis. And he was the first one to create a technical analysis course. And the classical technical analysis indicators started in the 20s, like the line, the accumulation distribution line. They started in the 20s. In 41, Standard & Poor's was created. And Schabacker was the editor for Forbes and New York Times, and he launched 3 books about stock analysis and technical analysis. And in 1948, Edwards and McGee published the first edition of Technical Analysis of Stock Trends. And it's interesting, I use this book in most of my basic technical analysis course. That's the main source for my main technical analysis course. Dow theory says that there are 3 trend directions. So now I'm moving into trends, because we need to understand trends to find high probability trades. So Dow said that there were 3 trend directions. It can be up, when higher highs and higher lows are happening. It can be down when lower highs and lower lows are happening. And it can be sideways when high and lows are about the same. So he also said that a trend has three parts. The first one is the primary or major that can last more than 6 months. Those are the big trends that I showed on the chart at the beginning. And they can be secondary intermediates, usually corrections within the primary change, and they can be minor, which would be the corrections within the secondary trends. So how it looks on charts. So here I have a session of a monthly chart. That same section on a weekly chart will show a lot more detail about those price moves. Notice that here it looks like this uptrend was very smooth and happened easily over the course of several months. When we look closely, we see that there were many corrections within that uptrend, even a sideways trend here, a large sideways trend here. If we go to the daily chart, we can see even more detail. And we see that within a long uptrend, like for example from here to here, we have several up and down moves. To find how high probability trades, we need to understand those little moves and find what's tradable, where we can find signals, entry and exit signals that can help us make money in the market. So let's set the stage for those statistical results that I'm going to show you today. I'm going to focus on the last 5 years for the statistical analysis, and I use daily data. I use the TSX, the 100 highest traded volume stocks on the TSX, because I'm in Canada, but the same type of results are valid for US markets, are valid for ETFs, and are valid for futures. I used automated testing on MetaStock to find how often the trend and no trend occurs. And I used 3 types of indicators to define what a trend is. The first one, which is very popular, is the zigzag indicator, and it has some good aspects, like it's easy to highlight an up and down trend. It's very visual. In general, technical analysts are very visual, and it's widely used. A lot of people use the zigzag to define trends. And it's always in the market. And here it's a double-sided sword, because time in the market, it relates to risk. The longer you are in the market, the riskier it is. So being always in the market, it's a double-edged sword. And there are bad things. It does not identify sideways trends. Being in the market, it's always being always in the market can be also bad. The parameters I used for the research was close price, reversal by 5% of price change, and that's how it looks on the chart, on the daily chart. Notice that every reversal will happen when the price drops by 5% or goes up by 5%. Then there is a change in direction. So that's the downtrends as defined by the zigzag indicator. when we look at that chart, we are looking into past data. So it's in hindsight. How much of each uh, transaction can be traded to make money? So I need to use statistics for that. And I need to know how often the zigzag found a uptrend and how often it found a downtrend, and what was the standard deviation, how broad was that analysis distribution. So standard deviation is fairly high, and the shape of the curve it's not good. It's a little bit distorted. I don't like that curve. Visually, I can tell you it's not a good statistical fit for the zigzag. And it's even worse when the trend is down. The standard deviation is lower, but the curve is totally distorted. So even though zigzag is used a lot by a lot of traders, in itself, it's statistically looking, it's not a really, really good indicator. So conclusions. In the last 5 years, 50% of the TSX stocks trended most of the time higher. And there's a significant percentage of stocks trending mostly down, and the distribution is very broad. We can also extend this same analysis to other sectors or individual stocks. We need to identify ways of isolating the sideways trend, because that would certainly make the analysis better. Another way of identifying trend direction, very popular, it's moving average direction. So if the moving average turns up, it's an up. If a moving average turns down, it's a downtrend. So good, it's easy to highlight an up and down trend. It's very visual also. It's widely used. And again, it's always in the market. So it's a double-edged sword. The bad is that it does not identify the sideways trend, and again, it's always in the market. Let's see what type of parameters are used for this research. Close price. I use the 20 days moving average, which is close to 1 month of trading, and I use this 20 days average because it shows me intermediate trends. So for swing traders, for example, we want to focus on the intermediate trends. And depending on the type of trend following strategy you're using, you want to focus on the intermediate trends. How it looks like on the chart, you can see here this a section of an uptrend and how the moving average direction changes when the trend is sideways or down, and identify the direction of the trend. So visually I can tell you that this curve is a little bit better than the zigzag. Standard deviation it's smaller. Average is very close to the median. And even though for the downtrends, the standard deviation is also low, but the curve is a little bit broader and broad here. So it's good, but it's not that good. Average and median are a little bit further apart. So some conclusions from this. In the last 5 years, more than 50% of the stocks trended most of the time higher. Since the median is 53%, there is still a significant percentage of stocks trending down. And the lowest standard deviation is good and should prove that moving average direction, it's a very robust way of defining trends. And we can extend this to different sectors and individual stocks. However, again, we need to identify the sideways trend, isolate this, because it will make the results better. So, sideways trend, it's one of the most difficult things to identify in the market. There are not many ways of doing this. I'm going to show you here one way of identifying sideways trend that you can find in the literature. I created two different ways of identifying sideways trend because I wanted a better definition of the sideways trend to comply with my strategies and again with my beliefs on how the markets work. But this one that I'm going to show, it's extremely robust and people use it. So what are the characteristics of a sideways trend? Volatility is lower, right? The price starts to move sideways, you have less move, and so volatility goes down. The averages do not trend much. They are not clearly going to one direction. It's a little bit up or a little bit down. And the averages will change direction several times, and the candles alternate between green and red. So what can we potentially use to identify this? Moving average angle, it's one way. We can check how steep is the moving average, and if the angle is low, we define that it is a sideways trend. We weight the moving average to have a steeper angle to accept a trend direction, either up or down. We can use Bollinger Bands. Bollinger Bands close when the volatility goes down, so we can use Bollinger Bands to identify periods of low volatility. And we can also use Keltner channels. They are not a very popular indicator because for trading, Bollinger Bands are a little bit better, but Keltner channels are a very important tool in the speculator toolbox. So let's see how it works, visually first. That's an uptrend with sections of sideways trends. When we put a Bollinger Band on top of that trend, we can see that when the price starts to go sideways, the Bollinger Bands close and the distance between the bands goes down. They approach, the top band gets closer to the bottom band. On a Keltner channel it's a channel with constant spacement between the top and lower bands of the channel, and the distance is 3 ATR. That's the distance between the top and bottom bands. And how you trade this? Well, when you get close to the bottom band, you buy expecting that price will go to the upper band, and so on. So that's how you trade the Keltner channel. But how you combine them? Let's see. First of all, is there a better one? So individually, there is no good choice. Both are good to identify sideways trend because the Bollinger Bands will get narrower, the width will be smaller, and in the Keltner channel, the price gets inside the bands. Oh, by the way, another way of trading the Keltner channel is when you have a close outside, you expect that price will continue outside until they go back inside the band. So that's a trend. It's another definition of a trend. So when we combine both, that's where the true power of those two indicators come. Notice that when we have very low volatility, the Bollinger Bands get inside the Keltner channel. And when that happens, prices start to move sideways or erratically. We don't have a lot of move here, so we don't have a lot of space to make money. So the key to define sideways trend is to use a combination of Bollinger Bands and Keltner channel. And when we do this, notice how good becomes the results. So when I isolate the sideways trends, I find that the trending days of the markets are fairly high. So the markets, 80% of the time, almost 80% of the time, it's either going up or down, which is very good for us. Trends can be up or down, and the standard deviation here, it's very low. It's only 7.23. There is no upside here because the market cannot go higher than 100%, right? So standard deviation is very low. There are no fat tails. Notice that the tail here, it's very, very uniform, very, very good. And it's a very good, it has a great potential to be a good filter. So when I combine the moving average direction with the Bollinger Band plus Keltner channel filter, what do I get? I will filter out the sideways move. I will filter out the lower volatility periods, and which are the periods where the averages change directions too often, and the candles are alternating between green and red. So the challenge is the filter delay, because the market starts to move sideways before the filter can catch the change. And sometimes we have very short trailing periods. So what happens? Standard deviation goes down significantly. It goes to 6.84%. Average and median gets very close for trend up. But for trend down, the standard deviation is still fairly high, and the curve it's distorted. Even though the average and the median are the same, the curve here it's distorted. So for uptrends, it's a very good filter to use. For downtrends, it's not perfect. So very good correlation when the trend is up, lower correlation when the trend is down, and Bollinger Bands and Keltner channel are a good filter. So as trader, we need to isolate the sessions where your strategies do not work well. And if we want to trade trends, buy low and sell high, we need to filter out when the markets are moving sideways. However, there are many, many other options to identify trends. For example, moving average cross, it's very, very popular. MACD, it's based on moving average crosses. Moving average as a boundary, being like a dynamic support and resistance. MACD also, it's good to identify trends, and many, many, many other ways of identifying trends. So pick and choose. There is no perfect one. The most important is that whatever indicator you choose, it needs to comply with your beliefs. And that's also another reason when I teach technical analysis, I do not teach exactly what I do. I teach several indicators and ways of using those indicators because different people are going to have different beliefs and want to use different tools. It's very difficult to create replicas of my belief. However, it's very easy for me as an educator to teach you the different tools so you can go and do your homework and identify the ones that fit your beliefs. And Martin Brink has that quote here, which I believe it's very true. The art of technical analysis, for it's an art, is to identify trend changes at an early stage and to maintain an investment position until the rate of evidence indicates that the trend has reversed. So we need to have evidence that there is a trend and enter the trend, and we need to have evidence that there is no trend to exit the position. And Ed Seykota also, which I like a lot, his methodologies, he says that being a successful trader is 60% mind, 30% risk management, and 10% system. Basically, a coin flip can make money in the market if you have the proper mind and risk management. That's why you should never, ever, ever trade with real money before you are profitable on paper. Because if you are not profitable on paper, you are not going to be profitable on the market. If you are not profitable trading one stock, one share at a time, you are not going to be profitable trading 1,000 shares at a time. So there are many, many demo platforms or trading softwares that you can use. And again, MetaStock is sponsoring that presentation. MetaStock was the tool that I used to study and learn how to trade the markets. And that's why I recommend MetaStock to all my students. To conclude this, I want to make sure that you understand that indicators are important, but we do not have to go to the point of becoming paralyzed by the analysis. We need to have a system that we trust, because if we don't trust the system, we are not going to follow it. The market can be challenging sometimes. Most of the times it's reasonably difficult to trade, and if we don't have a lot of trust, we will not have the proper mindset to overcome all the challenges. Just out of curiosity, that's what I use. I have here a chart. And I created a export advisor with the conditions that I want to enter a trade, and I have all those conditions highlighted here. My stops, my objectives, places where I exit the trade, my moving averages that I use as dynamic supports and resistance, my trend definition and no trend definition here. The indicators are created. This is ADX. Those two indicators here I created and I used to identify exhaustion and my entry in the market. So that's how I trade the markets. I use charts, and I have everything set up on MetaStock to help me find those trades. It's a lot easier when you can just hit a button and scan the market and find which stocks fill your trading conditions, your entry and exit conditions. That's another example with entries, both short and long, my stops that move together with the market. So that's what I do and how I trade the markets. So that's what I had to show you tonight or today evening, depending on where you are. If you are Western time like me, or Eastern time like most of the people. I'm open to questions if you have anything. And Hunter has also an offer, a special offer for you that had the patience to wait till now. Oh, by the way, this is the website where I post and sell subscription to my analysis, and that's my technical analysis training website. So the trendlines.com, it's the analysis site, and TA Academy, technicalanalysis.academy.com, it's my training, education website. Thank you very much, and Hunter, you have the microphone.
Wonderful. Thank you so much, Jose. Was really looking forward to this presentation, and you did not disappoint. You know, one of the things that sometimes we overlook is the simplicity of a system and being able to avoid, like Jose said, this analysis paralysis. Now, there's so many indicators out there. We have 250 built within MetaStock. Plus, there's many variations of all of those indicators. Finding out exactly what to use and how to combine those indicators and what system works for you is very important. Now, Jose covered a lot today, but what we wanted to do was have the ability to educate you a little bit further and get a little bit more involved with some of these indicators. So we are doing a special offer for the individuals that attended this webinar today. And what we'll do is 3 months of MetaStock, end of day, for $59 total. So basically you buy 1 month subscription to MetaStock, you get 2 additional months at no cost. We'll go ahead and throw in a training tutorial called Unleash the Power of MetaStock that goes through pretty much everything in regards to using MetaStock, from getting started to advanced indicator programming, etc. On top of that, since you'll be using MetaStock for 3 months, what we want to do is provide you a little bit more education, and I asked Jose to do this, and he was very gracious about doing so. So anyone that does sign up with this trial today, you know, for attending this webinar, is actually going to have access to an additional session that we're going to do with Jose here, probably in about a week. That is going to get, like I said, a little bit more in depth with a lot of these indicators, etc. Cover the ins and outs of you know, the different indicators that he was talking about, and kind of putting that all into a workflow. How to register for this? You can go to metastock.com/TA Academy 3-for-1 and register for it. You can, probably the easiest way is to either email Jose or myself, Jose CID at taacademy.com, or myself at hunter.smith@metastock.com. You can also call in and speak to one of our account representatives, and we also have the chat function if you just go to our website. So once again, give us a call, shoot us an email, register for this second session. It's going to be very insightful, and you know, you'll also have the ability to use MetaStock for the next 3 months. Once again, thank you very much for attending this session. We're looking forward to bringing you much more with Jose as well. Jose, thank you for speaking, and to all of you, as always, happy trading.
Thank you very much.